Welcome to the Deep Dive. We're here to break down complex ideas from our sources into knowledge you can actually use. Ever feel like you're just reacting to the market, maybe chasing moves without really understanding the mechanics behind them? Well, today we're diving into something fundamental, but yeah, often tricky: the dealing range in price action. Our mission here is simple: clarify how to spot these ranges correctly. Because honestly, getting this right, it's crucial for navigating the markets effectively. Let's come back to this core idea, and the source material puts it perfectly. The market moves only by means of large funds entering and exiting price. Seeks yield, so where yields are, and where yields are moving towards that is going to be a catalyst for where future price action will ensue. What that really boils down to for you is this: if you can't define that dealing range accurately, you're basically flying blind. You're missing the yield the market's actually targeting. This concept, it's your compass.
Okay, teacher, I hear you talk about highs and lows, and I try to use them, but, well, what makes a specific high or low the correct boundary for a dealing range in this method? It sounds straightforward when you explain it, but then I look at a chart, and suddenly it feels really complicated to pin down the right one.
That's a great question. And, it's a really common sticking point. I remember struggling with that myself, trying to figure out which swing actually mattered. See, it's not just any high or low that you happen to see. It's very specific. We're looking for the most recent impulse price swing. Think of it as the clear, strong move that really sets the current trading context. That's the move that dictates the landscape right now. And once we've nailed down that foundational impulse swing, then we start breaking it down internally. We look at key levels within it: equilibrium, premium, and discount. These aren't just random lines. There's strategic zones within that range. Zones that, well, institutions and algorithms pay close attention to. The source confirms this simply. Above equilibrium is what the premium market, and below 50% is a discount market.
Ah, okay. Equilibrium is the middle, 50%.
Exactly. And this is where the smart money thinking comes in, which is what we're always trying to align with, right? When price moves into that premium zone, that's the upper half of your range, smart money generally sees things as expensive relative to that impulse. They'll look for spots to sell.
Okay, premium means sell-side interest.
Generally, yes. And conversely, when price dips into the discount, the lower half, they see it as cheap. That's where they typically look for buying opportunities.
So discount is where they look to buy.
Right. And this logic applies whether the overall market profile is bullish or bearish. It's all about perceived value relative to that specific decisive price swing.
So let me see if I've got this. It's about spotting that decisive, energetic move first, identifying that impulse, and then once you have that, you kind of dissect it. Break it down into these premium and discount segments to see where value lies.
Precisely. You've nailed it. It's fundamentally about understanding market efficiency.
Efficiency, okay.
Yeah. And knowing where the algorithms are likely to target next based on liquidity. That impulse swing, that's your foundation.
Right. It's about anticipating, not just reacting.
Exactly. So now we know what it is conceptually. Let's get practical. How do we actually establish this dealing range on a chart? What are the core rules? This is your roadmap. Okay, rule number one: identify the impulse price swing. Really identify it. This isn't just any little wiggle. It has to be a clear, energetic, forceful move away from, say, a consolidation or a significant prior high or low. Our source calls it the most recent impulse leg or impulse price swing. This swing is everything. It's the bedrock.
Okay, so look for the power move, the one that stands out.
Yes. If you get this first step wrong, well, everything else downstream in your analysis is going to be flawed. It throws everything off.
Got it. Most recent, clear impulse. What's next?
Rule 2. Utilize the Fibonacci tool. This is where the fib comes in, and it's essential here. If you've identified a bearish impulse swing, a strong move down, you draw the fib from the high of that swing down to its low.
High to low for bearish.
Correct. And for a bullish impulse, a strong move up, you do the opposite. Draw from the low up to the high.
Low to high for bullish, okay.
And doing this instantly maps out those zones we talked about. Yeah. It visually shows you the premium area above the 50% line, the equilibrium right at 50%, and the discount area below 50%. Remember that bearish example? The fib is drawn from a high down to a price low. It gives you that immediate visual framework.
Okay, that makes sense. It segments the impulse visually.
Exactly. Now, rule 3. Focus on the optimal trade entry, OTE zones. Once your range is defined and your fib levels are on the chart, these OTE zones are your sweet spot, your high probability entry areas.
The sweet spot. Where's that exactly?
Typically, it falls between the 62% and the 79% Fibonacci retracement levels. So if you're looking to buy, you're watching for price to retrace down into this OTE zone within the discount area.
Okay, 62 to 79% in the discount for buys.
Yes. And for sells, you're looking for price to rally up into the OTE zone within the premium area. This is where smart money is often likely to step back in.
Right, same levels, but in the premium for sells.
You got it. It offers potentially better risk-reward setups. Okay, rule 4. Confirm with imbalances, or as they're often called, fair value gaps. Seeing a fair value gap either within that OTE zone itself or, importantly, within the strong displacement leg of the initial impulse swing, that adds huge validation to your potential entry.
Why is the imbalance so important?
Because, as the methodology highlights, without the imbalance, there is no order block. That imbalance is like an institutional footprint. It shows where the market moved quickly and efficiently, leaving gaps. It suggests where price might need to return to rebalance, often aligning nicely with our OTE levels.
Ah, okay. The imbalance confirms the strength and potential for price to revisit.
Precisely. It underpins the validity of the OTE. And finally, rule 5. Target opposing liquidity. Where are you aiming to take profits? Your target should always be the next clear, logical pool of liquidity that the market seems likely to reach for.
Opposing liquidity, like old highs or lows.
Exactly. It could be relative equal highs or lows, a significant old high or low that looks like it needs to be swept for orders resting there. The source has a great way of putting it. Laying fruit is how I teach. You want to have the easiest target and then allow the market to go farther and you just not be a part of it. It's okay.
Low-hanging fruit, the obvious target first.
Yes. Go for the clear high probability target.
Yeah.
Don't get greedy trying to catch the absolute top or bottom. Secure the gain, and if it runs further, that's fine. You don't need every pip.
That makes sense. Secure the profit. Okay. So this whole process, it feels really different. It's not just about drawing trend lines or finding spots where price bounced before, like traditional support and resistance. It feels deeper than that.
You're absolutely right. It is fundamentally different. And grasping that difference, that's critical. A lot of the retail concepts, static support resistance, they're often based purely on past reactions. There's not always a deep why behind them in terms of order flow. As the source points out, sometimes your interpretation is a private interpretation. It's what you believe. There may be a lot of other traders that have a similar mindset about that very thing, but simply because you think that doesn't make it true. It doesn't.
So just because a lot of people see a line doesn't mean it's institutionally relevant.
That's exactly. What we're doing here, focusing on these dealing ranges, the premium discount, the liquidity targets, we're trying to align with algorithmic principles and institutional order flow.
Algorithmic principles, like how programs trade.
Precisely. We're not just reacting. We're trying to anticipate where the smart money is likely to engage, where they need to find liquidity to fill their large orders. See, retail often jumps in after the move is well underway, chasing momentum. They're looking for confirmation that often comes too late.
Right, chasing the move.
We aim to understand why the market should move to a certain area, and we try to anticipate that before it happens. We actively anticipate price-seeking, opposing liquidity.
So you're positioning ahead of the expected move towards liquidity.
That's the goal. It often means we strategically look to enter longs where retail sells. We look to enter shorts where retail buys. It's counterintuitive to typical retail patterns sometimes.
Wow, okay. Thinking like the institution, not the crowd.
That's the essence of it. Okay, let's try a quick mental mini drill to help lock this in. When you think you've found your dealing range, run through these 3 quick checks in your head, like a checklist. Check 1. Is this really the most recent, clear impulse price swing? Did price show strong displacement? Did it leave an imbalance behind? Look for that undeniable energy.
Okay, check for the clear, forceful move.
Check 2. Does it define clear premium and discount zones? When you put the fib on that specific swing, do the 50, 62, 79% levels make sense? Do they fall at logical points within that energetic move?
Do the fib levels look right on that swing?
Yeah, if they look awkward or random, maybe you got the wrong swing. And check 3. Where is price right now relative to this range? Is it currently in premium or discount?
Premium or discount? Right now.
Yes. That tells you your immediate bias based on smart money principles within that specific range. Should you be leaning towards buys or sells in the short term?
Okay, that drill helps frame it. But I still find myself sometimes, well, like I asked before, sometimes I just see a swing and I want to put a fib on it. How do I really nail down that it's the right impulse swing for the current dealing range and not just some random volatility or a smaller pullback?
Right. That's a classic trap. And it comes back to really understanding what an impulse price swing means in this context. It's not just any up or down movement. We're looking for significance, energy, force. That key word is displacement.
Displacement, the powerful move away.
Exactly. A move that clearly breaks structure or moves rapidly away from an area, often leaving inefficiency like a fair value gap in its wake. It signals market intention. Don't focus on every tiny wiggle.
Yeah.
Look at the overall price structure, which move really shifted the market's immediate landscape. That's your dealing range foundation.
Okay, look for the significant shift, the displacement. Got it. And teacher, another thing, that OTE entry. What if price gets near it but doesn't quite trigger my order and then just takes off? Should I chase it then? I hate missing out.
Ah, FOMO, fear of missing out. That's a trader's biggest enemy sometimes. Look, the OTE is called the sweet spot for a reason. It's optimal. But optimal doesn't mean guaranteed. If the market doesn't give you that precise entry, you absolutely do not chase it. Chasing is low probability trading. It usually means entering at a worse price with more risk.
So just let it go.
Yes. Let it go. Remember, the source material even suggests discipline, like if it doesn't fill you by 11.30, pull the order. There are specific time windows, too. Patience is maybe the hardest skill, but it's essential. As the source says, there's more time waiting in between the setups than actually doing anything.
Wow, more waiting than trading.
Often, yes. Wait for the high probability setup, the low-hanging fruit objective. If it doesn't form perfectly, another one will come along. Don't force it.
Okay, patience, don't chase, wait for the clean setup.
Yeah.
Makes sense. One last question on this, teacher. All these concepts, the range, premium discount, OTE, liquidity, do they only work on certain time frames, like the 15-minute you often show? Or are they broader?
Fantastic question. And the answer is key. These concepts are generic. They are universal.
Universal. So any time frame.
Any time frame. It doesn't matter if you're looking at a 1-minute chart, 15-minute chart, daily, weekly, monthly. It doesn't matter. The same concepts hold true.
Even on, like, monthly charts.
Yes. The principles of how price moves between liquidity pools, how it uses premium and discount relative to impulse swings, that underlying market mechanic driven by order flow, it's fractal.
Fractal. Okay, so it applies everywhere. Forex, futures, stocks.
Exactly. Forex, futures, indices, commodities, stocks. The asset doesn't fundamentally change how liquidity operates.
Oh, really powerful, knowing it applies across the board.
It is. But with great power comes, well, the need to avoid common mistakes. And there are definitely pitfalls here. Even when you understand the rules, it's easy to stumble. Let's talk about the big 3 traps to avoid. First pitfall, overcomplication. Seriously. People love to add more indicators, more lines, mix in conflicting ideas.
Yeah, I can see how that happens. Trying to be more certain.
Right, but it usually just creates noise and confusion. The source is blunt. You don't need all of that stuff. The power here is in its focus. I'm giving you a very specific thing during a specific time of day, and if you focus there over a period of time, you'll start to see things that repeat. Keep it clean, stick to the core price action and liquidity concepts.
Okay, simplicity is key. Avoid indicator soup.
Exactly. Second pitfall, ignoring higher time frame context. This one is huge. We might be finding a great dealing range and OTE set up on the 15-minute chart, but if the daily or the weekly chart is screaming in the opposite direction, you're fighting a much bigger tide.
So always check the bigger picture first.
Always. Your analysis must be top-down. Understand the narrative on the daily, the 4-hour first. As I always say, if you have no foundation in the daily or 4-hour timeframes, you have absolutely zero reason to be this late in this stage of analysis.
Start high, then drill down. Context first.
Yes. Without that higher time frame bias, your lower time frame signals can easily mislead you. You'll be swimming against the current. And the third pitfall, maybe the most crucial, a lack of discipline and patience. We touched on this with chasing trades, but it goes deeper. This approach demands emotional control. It requires rigid rule following. It's not a suggestion. It's a requirement for long-term consistency. The source material doesn't mince words. You will do this or you will fail, period. End the story.
Wow, that's direct.
It has to be. Because if you deviate, if you let emotions drive your decisions, if you break your rules, you are still inherently taking on risk that will invariably result in you losing money.
So the rules are there to protect you from yourself, essentially.
Precisely. It requires rigid approaches to following rules and feeling the pain and suffering when you don't follow the rules. That pain, that's your feedback loop. It teaches you discipline faster than anything else.
Feel the pain. Okay. Learn from mistakes. Stick to the plan.
That's the path. It's not easy, but it's necessary. So, let's wrap up this deep dive. Mastering the dealing range. It's fundamentally about tuning into market efficiency and the flow of liquidity. It gives you a clear framework to anticipate, not just react. Remember the core actions. Identify that clear impulse swing. Use your fib to map out premium and discount. Patiently look for those optimal trade entries in the right zone. And always, always target logical opposing liquidity, that low-hanging fruit.
Impulse, fib, OTE, liquidity target.
Oh.
Got it.
And remember those guiding principles. Keep it simple, stay patient, and always, always respect the higher time frame narrative. This isn't just about technical analysis, It's about developing independent thought, building consistent analytical skill. It's a journey in mastering yourself as much as the market.
Yeah, I can see that. The discipline part is huge.
It really is. For digging deeper into this, applying it, refining it, you can find more resources and detailed guidance over at https://www.getgtrades.com/landing. And here's something to really think about as you go forward. Now that you understand a bit more about these, let's say, hidden mechanics, the dealing ranges, the hunt for liquidity, how does that change how you see every single price bar printing on your chart? What deeper layers of market behavior, driven by that invisible hand of smart money-seeking yield, might you start to uncover now? Think about that. It changes everything. We hope this deep dive helps you see the market with fresh eyes.